Hello, everybody. My name is Bennett Tchaikovsky, and welcome over here to my walkthrough video for exercise 2-9. This is from the textbook Intermediate Accounting, 17th edition, authors Don Kiso, Jerry Weinyan, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons, Wiley. All rights reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself or Bennett Tchaikovsky, and not the authors of the textbook or Wiley. Okay, so let's go ahead and get in on this action. All right, so we've got over here, we've got accounting principles and assumptions, comprehensive. Presented below are a number of business transactions that occurred during the current year for Gonzalez, Inc. In each of these situations, discuss the appropriateness of the journal entries in terms of generally accepted accounting principles. The president used his expense account to purchase a new Tahoe solely for personal use. The following journal entry was made. Okay, first off, in order for something to be an expense, it has to be an expense of the business for Gonzalez, right? If it's for personal use, you would not be debiting miscellaneous expense. You would say due from owner. Okay, or if you want to call it as a draw of the owner, you can call it a draw, but it's not an expense. It's not part of the revenues or what we earned, or the expenses, or basically the cost against those revenues. Letter B. Okay, merchandise inventory that costs $120,000 is reported on the balance sheet as $690. The expected selling price less estimated selling costs. The following entry was made to record the increase in value. So there's a few different problems here. The first one is for inventory, we're going to record it at the lower of cost or market, meaning that if it costs us $620, I can never write it up, right? I'm only going to recognize that increase in value is when I go through and I sell it, right? I cannot write up my inventory. What we're going to learn is, I believe it's in chapter 8 or chapter 9, we're going to be looking at the lower of cost or net realizable value. And so basically for that, cost me $620. So I have to leave it at that cost. What we will be learning about in intermediate accounting is that market value is the middle value of replacement cost, net realizable value, and then net realizable value minus a normal profit margin. So that's what that one is. So letter B, that's letter B. So we can never, and again, if I'm looking at, what do they ask me to do? So you can't recognize revenue on inventory that's on inventory increasing in value. Okay, you got to sell it. Okay, the company is being sued for $500,000 by a customer who claims damages for personal injury apparently caused by a defective product. Company attorneys feel extremely confident that the company will have no liability for damages resulting from the situation. Nevertheless, the company decides to make the following entry. Okay, now, when you go through and record liabilities on a financial statement, you have to follow something. I think it's called Statement of Financial Accounting Standards 5. They may have changed the name, but that's what it was. And when we look at this, what we're really looking at it's in terms of liabilities. When do we record the liability? We're going to record it and disclose it, meaning that we would actually do this if it's probable and we're able to estimate, right? However, if it's reasonably possible and we can estimate the amount, or if it's reasonably possible, or if it's probable but we cannot estimate the amount, we're going to disclose it. The only time we record and disclose is if the two factors, it's got to be probable, and it also has to be, we have to reasonably estimate it. Okay, now, problem here is it's remote, right? The attorneys feel extremely confident that the company will have no liability. Therefore, we don't do anything. There will be a little bit of a blurb in the financial statements that we get in lawsuits from time to time, but that's what we go through and do. Okay, take a look at letter D. Because the general level of price is increased. Oh, that sounds like 2021 already. Just slightly. Gonzalez determined that there was a $16,000 understatement of depreciation expense on its equipment and decided to record it in its accounts. The following entry was made. Generally, when it comes to inflation or price increases, that's not going to impact the way that we go through and record transactions. We cannot record more depreciation expense just because of inflation. Now, when would we, however, if there's a change in estimate, meaning that my estimated useful life has changed, my estimated salvage value has changed, then I may go through and make an entry. However, generally there's something that's called the monetary unit assumption. And well, that's more of if we can show things in dollars, but over here for this, in this particular case, you wouldn't make that kind of an entry, right? You're not going to go through and do that kind of entry. Now, if the dollar, now if it's something like an international situation, right, where you're going through and you've got, yeah, but even then it really would make a difference. So just like let's let it lie. You're not going to do anything just because of general price increases. You only change the depreciation expense is if you have a change in the estimated useful life or if you have a change in the salvage value. Now, because of a fire sale, equipment obviously worth $200,000 was acquired at a cost of $155,000. The following entry was made. Okay. You never recognize revenue because it's not a sale, right? So this is not revenue. I'm just buying equipment at a bargain price. And what would I do? I would debit equipment, credit cash. Now, if I sell the equipment tomorrow and I make 45 grand, then it's going to be other income. It's not going to be sales revenue unless I'm in the business of selling equipment. But even something like this, I just bought it and I'm recording revenue against it. Yeah, no way. You can't do that. So that's that particular one. So again, these types of questions, like, as you're going through, and again, you can't recognize revenue unless you've sold something or you've earned interest. You have to, what have I earned it? That's when you go through and recognize the revenue. So thank you for watching today. That was exercise 2-9. And I look for, by the way, I want to also, before I leave, I always give out the shout out to Wiley. I want to thank you, Wiley. Please don't forget to like and subscribe. If you need any other solutions, please feel free to ask for them in the comments. Have a great day.